So we have finished our discussion on currency futures contracts. So let's talk about stock index contracts. So by the name, you would know that these are future contracts which are written on equity indexes. The most famous one would be the E-mini SP 500. So it's a futures contract based on SP 500. This contract has a $50 multiplier, and later you will see what does this mean. But now let's just remember that this contract has this $50 multiplier. Okay, now let's first look at the payoff to futures contracts based on equity indexes. So let's assume the stock index on the maturity date has a value of ST. So you can see that by the definition of futures, the profit to the long side would be ST minus F0. So here, ST is the spot price on the delivery date. And F0 would be the initial future price. Okay, so let's see a E-mini SP 500 example. So let's say this E-mini SP 500 has a future price of 2000 and the final index value is 2005. So in this case, you can see that the profit would be the spot price on this delivery date minus the initial minus the initial futures price. However, remember we talked about this multiplier. So for this each contract, we have to use this multiplier to multiply this profit. So this gives us $250. Okay, we would want to discuss two applications of futures. Well, when we're talking about two applications, you might have guessed it, right? Because for futures, we know that you can use futures for hedging, that's obvious. And then you could also use futures to do speculation, right? So basically, we will talk about, first, we will talk about speculation by using this synthetic stock position. And second, we will talk about hedging. So it's somewhat obvious to see that you could use this index futures to invest in equity market, right? Because you can see that, let's say if you wanted to buy SP 500, the most obvious choice is you could buy a ETF, which is based on SP 500, right? If you correctly size your position, your payoff from investing in SP 500 index can be replicated by your investment in this E-mini futures, right? So to be more specific, you can actually use T-bills and E-mini index futures to replicate the payoff from holding this SP 500 index. Essentially, you will take a long position in the index futures. Again, when you're entering a long position, you don't need to spend any money. So you will still have your money in your pocket. And then you should invest your money in T-bill. So you will create a portfolio of T-bill plus index futures. And the payoff to this portfolio would be the same as the payoff you can get from directly investing in SP 500. So essentially you can see that using T-bill and index futures, you can create a synthetic equity position. So let's see how this works. It's actually very, very simple. So let's say an investor wants to invest $100 million in SP 500. Instead of using SPY ETF, let's say this investor decides to use SP 500 E-mini futures. So she would want to create a synthetic position. Now let's say the index now is at 2000. And then let's assume the 1 month delivery future price is 2020. And let's say the T-bill rate is 1% per month. Okay. How many contracts will this investor buy? So this is the first question. The second question is verify that this T-bill plus futures position has the same payoff as the equity position. So let's think about how could we solve the first problem, right? How many contracts would this investor buy? Well, as I said, this is a very simple question. So if you want to invest $100 million, and then you know that now the index futures price is 2000, right? So basically what you will do is you should use $100 million divided by 1000. It's like one contract represents $2,000. However, you have to remember we have this $50 multiplier. So essentially, one futures contract represents 2000 times 50, right? Okay, so let me write this down. So one contract represents 2000 times 50, which would be, I think it's 100,000. Yeah, it's 100,000. And then the number of contracts needed would be given by the total amount you want to invest, which is $100 million. Divided by the per contract value. So this gives us, I think it's 1000. It gives us 1000 contract. Let me see if it's 1000 contract. Yes. So you will buy 1000 contract. Now second, it says verify that the T-bill plus futures position has the same payoff as the equity position. So now let's first think about the stock position. That is, you actually use this $100 million to buy this SP 500. And you know that you have $100 million. So in this case, you can see you can buy how many shares? So let's assume the per share price is 2000, right? So you will buy, this is hard math. I believe it's this number. Am I right? No, it's not. So I think it's it should be 50,000. I think it should be 50,000. Okay. So let's assume index value the delivery date is PT. So you can see that in this case, the value of your investment, right, should be 50,000 times PT. Now let's examine your T-bill plus futures position. Obviously, you have two investments here, T-bills and futures. As I said, when you enter into this futures contract, you will have this $100 million in your pocket. So you want to invest this $100 million into this T-bills. And the T-bill rate is 1%, right? So this tells you at date T, or on this delivery date, the value of T-bill investment would be $100 million times 1 plus 1%. So it's $101 million. Right? Now, value of your futures position. Well, let's see. You have 1,000 futures. Right? So the value of your futures position would be 1,000 times PT minus futures price, right? What is your futures price? It's 2020. Well, you have to remember that we have this contract multiplier. Right? So 50 times this. This will give us 50,000 times PT minus 101,000,000. Right? So if we combine these two positions, that is, if we combine the position from the T-bill, that is this guy, and the position from the futures, you will see that the total value from your T-bill and futures position would be, obviously, these two numbers, they would just cancel out, right? So you can see that obviously the final payoff of your portfolio would be 50,000 PT. So you can see that these two numbers definitely are the same. So essentially what you're seeing here is you're using this futures investment to replicate your investment in actual equities. Okay. Now the second application is hedging risk, right? So here, think about this. Let's say you have a long position, and then you expect there would be a market downturn, right? So you know that your equity position would suffer. What can you do? Well, first, you can just sell all your equity positions, right? Because in this case, you might think, okay, if I sell all my equities, then I could avoid this market downturn. And after this downturn, I can buy back all my equities, right? But you can see that in reality, this actually has some costs. The first is transaction cost. This is more true in Canada, because in Canada, transaction costs are actually higher because you have to pay fees, right? And then the second one is about tax implication. Basically, if you sell your equity position, then you will have realized capital gains. In this case, if you realize capital gain, then you will have to pay tax, right? So you can see that this has both transaction cost implication and tax implication. A alternative is, well, we talk about this, you could use put option, right? But that's not our focus here. Then the third alternative is you could use a short position in index futures. So in this case, using index futures is actually faster because you don't need to sell a lot of different shares, and it's also cheaper. Now, how do you decide how many contracts you would need to hedge your portfolio? Well, you would use your portfolio's beta, right? So, I mean, it's like in all hedging questions, you have to think about hedge ratio. Right? If you're using a short position in index futures to hedge your long position in equities, then you will use equities beta to determine the hedge ratio. If you have satisfied the prerequisites for this course, then you should have a good understanding in beta. But roughly speaking, right, when we talk about beta, to put it simply, we are referring to the beta from capital asset price model, CAPM, right? So we know that the expected return of a particular equity equals risk-free rate plus beta of this particular stock I times the expected return of the market minus the risk-free rate. Right? Sorry. Empirically, beta can be defined as the change in stock return divided by the change in market return. This is not entirely correct, but I don't want to talk too much about this because empirically you have to use regression to solve this, and using delta Ri divided by delta M is actually misleading. But however, I think it's a simpler way to understand beta. Oh, sorry. Okay, so let's see this example here. So here we're trying to hedge away market risk. Let's say you're a fund manager. You manage a $30 million portfolio. And you have calculated the portfolio beta is 0.8. Let's say again the SP 500 index is currently at 2000. And you worry that the market will be going down. And to be more specific, let's assume the market index will actually drop to 1950. So how can you use index futures to hedge against this possible downside risk? Well, obviously you would know that you should take a short position in this index futures. But the real question is, how many contracts, right? That's the real question. So we have to think about hedge ratio. So our task is we would start from this guy. What is the hedge ratio? So you can see that in this case, we will want to calculate hedge ratio as change in your portfolio value divided by change in your futures value, right? So let's see how could we find out this. So let's say the SP 500 index decreases from 2000 to 1950. Now, what is the change in your portfolio's value? Well, obviously your portfolio value will be lower, right? And you can see that if you use the beta here you can see that if the market changes from 2000 to 1950, then the market drops by 50 divided by 2000. So there is a 2.5% drop in the market. And then you can see that the portfolio has a beta of 0.8. So in this case, the portfolio's value will drop by 2.5% times beta 0.8, which is 2%. So here we are essentially using this formula here. Right? You can see that if beta is 0.8 and if market drops by 2.5%, then you can see that the drop in your portfolio's return would be 2%. So you will get this number here. Okay, so now, we have a $30 million portfolio. So you can see that the value drop. So the portfolio value will drop by, so the dollar value would be $30 million times 2%, which is $0.6 million, which is 600,000. Now let's think about your futures position. Right? So you can see that again for futures position, if 2000 drops to 1950, you can see that the profit, remember you have a short position in the profit. Your profit would be 2000 minus 1950 per contract. Again, don't forget the $50 multiplier. So your per contract profit would be 250. Right? So now you can see that the hedge ratio could be calculated by the change in the portfolio value, which is 600,000, divided by the change in the futures position. This gives you, I don't know. This gives you what? Sorry. This should be 25. Yeah, this should be 2,500. So this gives you 240 contract, right? So you should take 240. Sorry. So you should take a short position in 240 contracts. There's actually a quicker way to solve this. If you look at this, so if you have $30 million, the beta is 0.8, then it means that to offset the loss from the $30 million portfolio, you have to invest $24 million in futures contract, right? And we know that per contract represents 2,000 times 50. Right? This is the current index value, this guy here. 50 is the contract multiplier. So this will directly give you 240. Of course, if you, this is really a quicker way to solve this after you get familiar with this kind of hedging problems. But it's fine if you could just follow this more normal process here, right? Calculating these changes and finding out this hedge ratio. Then it's also fine. Okay, now let's see a second example about hedging against the market risk. So here we are talking about the so-called market neutral active stock selection. The idea is like this. Let's say you're thinking, okay, I'll give you a more concrete example. Let's say you think Google stock, right, is underpriced. Well, since it's underpriced, Now you want to buy it, right? So your action would be buy it. But now you can see that what you're trying to bet here is Google is underpriced. So in the future, its price will catch up and you will earn a profit. So that's your investment assumption, your investment thesis here. But you can see that Google is positively correlated with the market. So now you have this worry, right? You would worry that a downturn in the market you're worried because even if Google is underpriced, but if there is a big market downturn, still you will lose money, right? So here you want to hedge against this possible market downturn, right? To be more, to say this in a fancier way, you want to separate your bet on Google from your bet on the market. So basically, you can consider this. Google's price contains two components, right? The first component is the market component. The second component is the additional return from this underpricing. You only want to bet on this additional returns from the underpricing. You don't want to bet on this market return. So what you want to do is you will want to use a short position in the market index to remove the market movement. So that's why this is called market neutral investment, because you want to remove the market impact, right? So if you can successfully move market impact, then you will make a very pure bet. This pure bet is to bet the stock price will play catch up, no matter how market changes, and you will earn a profit, right? Okay, so let's see this example in more numerical terms. So let's say the manager has purchased, what is the number here? 750,000 equity, and this equity has a beta of 2/3, right? So it has this positive correlation with the market. And the manager believes possibly there would be a 3% downturn in the market. And let's assume again SP 500 is at 2000. Now how can the manager use index future contract to hedge his market exposure? Well, again, very obvious. You want to take a short position in this index futures, right? Again, the question is, how do you find out the hedge ratio, right? Okay, so our task is about hedge ratio. Now to find out hedge ratio, we will first find out the value change in your equity position, right? So let's say if there is a 3% drawdown, 3% downturn. Let me use more easy terminology. So 3% downturn. Now, in this case, let's see what is your loss on your $750,000 portfolio. So if there is a 3% downturn, remember this is market downturn. However, your equity position has a beta of 2/3. This means your stock would have a downturn of 2%, right? And the value of your equity position is 750,000. So this implies your loss from the equity position is 70,000 times 2%. So this would give you 150,000. Now let's think about, for the same 3% downturn, what is your gain from your futures position, Okay, so your futures position is, remember that your futures was at 2000. So if there's a 3% downturn, what could be the index value here? Oh, 60%. Okay, so if there's a 3% downturn, then the index value will drop from 2000 to, what is the number here? Oh, 40. Will drop to 1960, right? And in this case, you can see that per contract, the gain would be multiplier times 2000 minus this. So this is gain, and it's per contract gain. So this would give you 50 times 60, which would be 3000. So now you can find out the hedge ratio. So the hedge ratio would be the value change in your equity position, which is 15000, divided by the value change per one futures contract, 3000. So this gives you 50. Okay, let me double check. No, it's not 50. It's actually 5. Is it 5? Okay, yeah, it is 5. So it basically says that if you want to make a market neutral bet, then for this $750,000 equity position, you should take a short position in 5 index futures contract. Again, you have a shortcut to solve this. Oh, sorry for this. Oh boy, where's this? Oh, finally. Oh, it's not this. Sorry. Okay, now you can see that the beta is 2/3. So if you wanted to offset the loss from this amount of your equity position, what is your amount to invest in this stock index? Well, it should be 7500 times 2/3, which is 500,000. And then you can see that per contract represents 100 times 100 times 2000. So this will give you 5. You can quickly find out you will use 5 futures contract. Okay, great. Now let's talk about a third type of futures, that is interest rate futures. So the purpose of interest rate futures, so here our goal is to focus on how to use interest rate futures to hedge against interest rate risk. So we're really just trying to think about its hedging function here. Obviously, you could use this futures for making money, to do some speculation on how interest rate will move. But here, our focus is just about hedging against the risk. So a typical example is you wanted to protect your gains against a rise in interest rates. So here the scenario works like this. Let's say you have a bond portfolio, and we have learned if interest rate increases, the bond portfolio's value will decrease, right? Because always interest rate increases, bond price decreases, right? So interest rate increases, your investment in bonds will suffer. Now you can use interest rate futures to hedge against this downside risk. So let's see this example here. So let's assume a portfolio manager has a $10 million bond portfolio. And we assume this bond portfolio has a modified duration of 9 years. When you're solving problems, you have to be careful with duration versus modified duration, right? Because modified duration D star equals D divided by 1 plus yield. Right? And the manager is worried there could be a 10 basis points rise in interest rates. Well, we know that 1 basis point is 1 over 10,000. So 10 basis points represent 0.1% rise in interest rates. And now, to hedge against this interest rate risk, the manager can take a short position in a T-bond futures. So in this case, let's see how this T-bond futures work. So let's say the Treasury bond futures require a delivery of $100,000 of par value. And we assume the delivered bonds have 6% coupon rate and 20-year maturity. Let's assume these Treasury bonds have a modified duration of 10 years. And now let's assume the futures price is $90 for $100 par value. And you can see here that one contract, right, requires a delivery of $100,000 par value. So you can see that the contract multiplier is given by the total delivery amount per contract divided by par value 100. So it's 1,000. Right? Okay. Now let's see how this fund manager can use this T-bond futures to hedge against interest rate risk. Now again, the crucial question is to hedge against this $10 million bond portfolio. How many contracts, right? This manager should take a short position. Right? That's the question here. So obviously you have to think about hedge ratio. So let's see how could we find out hedge ratio here. Now first, let's think how the bond portfolio, that is how the fund manager's bond portfolio's value will change if there is a 0.1% rise in interest rate, right? So there is a interest rate increase. So we want to find out the change in this manager's bond portfolio. Well, this is easy, right? Because you can see that we know the bond has a modified duration of 9 years. So you can see that in this case, the change okay, let me just use the loss. Okay. The loss of the bond portfolio would be given by the value of the bond, which is $10 million, times the duration, the modified duration, which is 9, times the change in the yield, which is 0.1%. So this should be, I guess it's 9. Yeah, it's not 9. It's $0.9 million, which is I think it's 90,000. Let me verify. Yes, it's $90,000, right? So you can see that, to be more specific, it's $90,000 per 10 basis points, right? And then we can find out the loss is 9,000 for 1 basis point. That is, if the interest rate increases by 1 basis point, the bond portfolio will lose $9,000. So we have a name for this number. It's called price value of a basis point. So it's called RVBP. It's not RVBP. This is not right. It's PVBP. How come this is RVBP? So the PVBP for this bond portfolio is $9,000 per basis point. Okay, now let's look at the second guy. So now we want to look at your gain from your T-bond futures contract. So you can see that for this T-bond contract, these treasury bonds have a duration of 10 years, right? And for one contract, it has a value of 90, but then you have to use the multiplier here. So this is essentially the value of this contract, and then times its modified duration, and then times the change in the interest rate, which is again 0.1%. So this gives us 90,000. And now you can see that, it's not 90,000. It's not. It should be 90,000 times 1%. So it should be 900, right? And this is 900 for 10 basis points. And then you can see that for 1 basis point, it's 90, right? So it's 90 per 1 basis point. And then you can calculate the hedge ratio here. So the hedge ratio would be the change in your bond portfolio divided by the change in your futures contract. So it's 100 contract. Okay. Okay, now let's talk about a slightly more complicated form of futures contract. These are not exactly futures contracts. It's called swaps. So these guys are essentially a extension of futures contracts. To be more specific, swaps are multiple period extensions of future contracts. So think about this. What is a futures contract? Right? For one futures contract, on day 0, you would enter into this contract agreement. And on this delivery date, right? If you're the seller, then you will make the delivery. If you're the buyer or if you're taking the long side, then you will take the delivery. Right? So it's just a one period agreement. So what is a swap? Well, if you extend this future contract for a second period, then this is a swap. Okay. So there are basically two kinds of swaps. The first is the foreign exchange swap. It is about exchanging one currency for a different currency on several future dates. You can see that the key here is several, right? Because it's a multiple period futures contract. So you have to exchange for several different periods. That's why you have multiple future dates. And then the second type of swap is interest rate swap. For this type of swap, you will essentially exchange cash flows based on a fixed rate for cash flows based on a floating rate. Again, on several different future dates. Right? I guess this sentence here is somewhat confusing. So let me put down some remarks here. So you're exchanging this guy, cash flow from a fixed rate for cash flow based on a floating rate. Right? So you basically have two sets of cash flows. One is based on a fixed rate. Another one is based on a floating rate. And you're exchanging these two sets of cash flows with each other in a swap agreement. That's how interest rate swap works. Now let's see this example here. So let's say the manager holds a portfolio of $100 million. This is par value. And this portfolio will pay an average coupon rate of 7%. And the manager thinks the interest rate is about to rise. And now the manager would enter into a swap with a dealer to swap a payment of 7% times $100 million for a payment of LIBOR times $100 million. Okay, let me explain here what we are doing here, what is going on here. So first, it basically says you're a investor in a bond, and this bond has a par value of $100 million. And then this bond has a fixed coupon rate of 7%. So essentially, it basically says that if you hold this bond, then every year you will get this fixed 7% interest payment, right? But now let's say you think the market interest rate will increase. So let's say you think the market interest rate will increase from 9% to 10%. Now you can see that in this case, holding this bond is actually a bad idea because you can only get 7%. However, the market can actually give you 10%, right? So what can you do? Well, one way is you can basically sell your bond, right? Another way is you could use a fancier method, right? In this case, you can enter into a swap with a dealer. Typically, this dealer will be a bank. Right? So you can enter this agreement with a dealer. This agreement will say something like this. You, the investor, will exchange your fixed interest payment for the payment from the market interest rate. So here the LIBOR rate. So LIBOR is the London Interbank Offered Rate. So it's the interest rate used between banks located in London. Right? So it's a market rate. The name here is really not important. So it's a market rate. To be more vivid, this is a floating rate, which means this rate actually changes according to the market condition. This is very different from 7%, right? Because if you have this bond, you will always get 7%. So you can see that here, if your guess is right, you will actually get some profit, right? Because you can see that as this bond investor, your profit from this agreement is the market interest rate minus the coupon rate times your bond par value, right? $100 million. Again, what you're doing is you will give up your income from your fixed coupon rate bond. And you give up this income in exchange for this LIBOR rate times $100 million. So essentially, you can see that you're exchanging this fixed rate interest income for market rate interest income. And you can see that if you're right, if market rate indeed increases, you will earn a positive profit. So that's the motivation. That's why you want to do this. And you can also see that this is a multiple period agreement, right? Because you can see that a bond, and you can see that here you're having a long-term bond. So essentially, if you have a, let's say if you have a 10-year bonds, and this bond will pay 10 annual coupon payments. So you can see that in this swap agreement, for this 10-year bond, this agreement will actually have 10 periods. Right? So this is obviously different from a futures contract, which will only last for one period. Okay, now let's verify you will actually get this market interest rate payment. So let's see what is your income from this bond plus swap agreement, right? Now let's say the market interest rate is, let's say it's 7%. Now you can see that obviously the interest income from your bond portfolio would be this, right? And then you can see that the cash flow from this agreement would be 0, because you can see that the cash flow from the agreement is the difference in the interest rate times your $100 million of par value. So if it's 7.5, then you can see that this is the interest income from your bond portfolio, and then the net cash flow from your agreement would be the difference, right? That is 7.5% minus 7% times $100 million. So this gives you 7, I guess it's $7.5 million. It's not. I think it's $500,000. Yes, $500,000. Right. So in the end, you will have this amount, and you can see that this is exactly right. This is exactly 7.5% times $100 million. I mean, you can see that this is actually a very convoluted way to understand this. To put it simply, you can see that your interest income would be your net gain plus 7% times 100 million. And then you can see that these two cash flows will just cancel out. So in the end, your interest income is the market interest rate times $100 million. Right? So you can also see why this is called a swap agreement, right? Because you can see that in the beginning, before entering this agreement, your interest income is always 7% times $100 million. And by entering this swap agreement, now your income becomes the LIBOR rate times $100 million, right? So it's as if you're swapping this amount for this amount. So you can see that it's a fairly intuitive name. Let's see some applications of this swap agreement. You can see that this could be quite useful, right? Because if you enter into a swap agreement, then you can actually convert between a fixed rate and a market rate. Of course, whether you want to convert from a fixed rate to a market rate or a market rate to a fixed rate really depends on whether you're a lender or a borrower. And it also depends on what is your forecast, whether you forecast the market rate will increase or decrease. So let's see two other examples here. So let's say there's a firm, and this firm has issued some fixed rate debt. And the firm forecast the interest rate will fall. Now, what this firm can do? Well, the firm can actually enter a swap agreement. In this case, the firm will pay a fixed rate and it will receive, in this case, the firm will pay a market floating rate and it will receive a fixed interest rate. Now, let's see how this works. So let's see we have a firm here. And then the other party is the dealer, who will actually enter this agreement from this firm. Remember that this firm has issued fixed rate debt. So there are actually a third party, debt holder, right? So you can see that the firm has to pay this fixed rate. Let's assume the fixed rate is 5%. Now, the firm has some forecast. The firm thinks, well, in the future, the market rate will actually decrease. Let's say the firm forecasts the rate will decrease to 3%. So you can see that if the rate decreases to 3%, continuing to pay its debt holders 5% rate is undesirable, right? What the firm can do? The firm can enter this swap agreement from a dealer. In this case, you can see that the firm will try to receive, let's say it will try to receive this 5% fixed rate. And it will pay the dealer this market rate. Okay, let me follow the lecture, this floating rate. So you can see that if the firm's forecast is correct, the market rate is actually 3%, then you can see that the firm receives 5% and then it pays out this 5% for its debt holders. And in the end, the cost of the debt to this firm is only 3%, right? So in this case, you can see that a borrower who forecasts the interest rate will fall will try to enter a swap agreement which pays floating rate and receives fixed rate from the firm's perspective. Right? Now let's look at the second case. So in the second case, let's say we have a bank. And this bank is paying money to some depositors. And let's assume in this case, the bank is paying market rate. Right? Now, let's say the bank has made some forecasts and it finds out possibly in the future the market rate will actually increase, right? Now, what's the natural thinking? Well, obviously the bank will not want this increase, this increased interest rates, right? So it will try to lock in this lower rate. Now, what the bank can do is it could enter a swap agreement with the dealer. In this time, it will receive the market rate. And it will pay the fixed rate. So let's say the fixed rate now is 4%. And if market rate indeed increases, let's say if it increases to 5%, you can see that in this case, bank receives the interest payment from the dealer and the bank will pays out the market rate to its depositors, right? So in the end, the cost to the bank will always be 4%. So in this case, you can see that bank will remove this interest rate risk because no matter what is the market interest rate, in the end, the bank will always pay out 4% fixed rate, right? Pretty neat. Okay. Now, you might wonder one question. So it seems that, let's say if the market rate indeed increases to 5%, it seems that this dealer is losing money, right? So why this dealer wanted to enter into this agreement with the bank? Right? Now let's see how this works. So this is a very nice picture which gives you a clear idea why some banks will want to become a dealer. So let's say there are two firms, firm A and B. Now the firm A enters a contract with the dealer, right? In this case, the firm A wants to pay the dealer the market interest rate, and the dealer will pay the company A a fixed rate. Right? So why the firm A wants a fixed rate? Well, maybe because the firm A has issued some bond, and this bond has a 7% fixed coupon rate. Right? So the firm A has this liability, and it wanted to use the cash flow it received from the dealer to pay this coupon payments. Now, let's look at firm B. Now, firm B also wants to enter agreement with the dealer. In this case, the firm would actually pay a fixed rate to the dealer, and the dealer will pay this LIBOR rate, this market rate, to firm B. Right? Why firm B wanted to do that? Well, maybe the firm B has some liability which pays interest which is tied to this floating rate. Now, the important thing is, you can see that if you look at this circled part, right? What you can see is the dealer has no interest risk because after receiving LIBOR, it will also pay LIBOR, right? So here, interest rate will just disappear. And why this dealer wanted to enter into this swap contract? Well, because you can see that it can earn some interest differential, right? Or interest spread. Let's use differential. You can see that it receives 7.05% from firm B, and it pays 6.95%. So there is a positive 1% interest rate differential here, right? So if the agreement has a notional value of $100 million, you can see that the bank can earn from this swap agreement, I think it's $1 million, right? So it can earn $1 million from this interest differential. So it's a pretty clever way to earn money, right? So that's why banks would be happy to enter into these swap agreements. Okay, last, let's talk about swap pricing. So a very obvious question is how this swap rate is determined, right? So here we will focus on foreign exchange swap, and we will want to find out what is the fair swap rate between dollars and pounds. The methodology can also be used in this interest rate swap. That is, what is the LIBOR rate should be exchanged for the interest rate. Okay, so what is the idea here? How can we find out the fair swap rate? Well, we will use the replication method. That is, a swap agreement can be replicated by multiple futures contracts. Because we know that swap is essentially an extension of futures contract. So you can think something like this. Okay, I'll just directly use this example here. So now, let's say you want to exchange dollars for pounds for 2 years, right? Now you could first use a swap. So let's say you'll first use a swap agreement. In this case, let's say at the end of the first year, right, you will receive £1 and you will pay F star dollars. This is essentially a exchange rate. And then at the end of the second year, you will receive £1. And in exchange for £1, you will pay F star dollars. Again, this is essentially a exchange rate. This can be replicated by two futures contract, right? You could use two currency futures. For the first contract, let's say its exchange rate at the end of the year is given by F1. And then you could enter into the second contract. Let's say the second contract at the end of the second year would be given by F2 star. That is, for the first contract, you pay, sorry, I should not use F2. So I should use, I should just use F2 here. Let me be consistent with the lecture notations. So this basically says in the first year, using the first futures contract, you pay this F1 dollar and you will get £1. And then using the second futures contract, you pay F2 dollar. You will get this £1. What you can see here is the first method and the second method, they will give you the same payoff, right? What is your payoff, right? Well, per year you will get £1. For 2 years, you will get a total of £2. Using swap, you get £2. Using two futures, you get £2. So you can see that you have the same payoff. This basically means if you have same payoff under two strategies, then you should have the same costs, right? Now, what is your cost in this swap case? Well, you will pay out this amount of dollars, F star amount of dollars at the end of the first year. And you will pay the same amount at this at the end of the second year. So your cost is F star 1 plus Y1. Here the Y1 is really the discount factor you will use. And then F star divided by 1 plus Y2 squared. Now in this two futures contract case, your total cost would be F1 divided by 1 plus Y1 plus F2 divided by 1 plus Y2, right? So you can see that this equality must be must be correct. Again, Y1 and Y2 are just discount factors for discounting dollar cash flows at the end of the first year, at the end of the second year, right? Okay, now let's use this formula to find out the price for a currency swap. So let's say you enter a swap to exchange currency for 2 years, right? In this swap agreement, you will have a fixed exchange rate for the entire duration of this swap agreement. Now, current spot exchange rate is E0. Again, you can see that we are talking about exchanging dollars for pounds. And annual interest rate is in the US 5%, in the UK 7%. What is the fixed exchange rate on this swap agreement? Well, clearly we have to find out F1. What is F1? F1 is the futures exchange rate on the first 1 year future, right? So what you will do here is you will use the interest rate parity theorem. We learned that F1 equals E0, 1 plus 1 plus R US, 1 plus R UK, right? So let me just copy answer. So it's 1.992. And then F2, which is the futures exchange rate at the end of the second year for the second futures. So you have 1 plus RUS, 1 plus RUK squared. So essentially, we have two futures contract. This guy here is 1.992, and this guy here would be 1.955. So 1.955. And then you can see that we will finally be able to use the formula we just talked about. So what is the discount factor here? Well, you will just use 5% because you're a US person, right? Because you're exchanging US dollars for this UK pound. So let's just use 5% as the discount factor. And then plug in numbers, plug in F1 and F2, you can solve F star, which is given by 1.974. Okay, I still have several pages left, so let's talk about this in the next lecture.